Welcome. In this video, when will the XCN coin downtrend end? We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand. When we closely examine the chart in a short-term time frame, a clearly defined and notable descending trend line becomes evident. This trend line represents the primary direction that the price has been following over the past several sessions. For investors focused on technical analysis and aiming to identify market direction changes, such trend lines hold crucial importance. These lines help interpret key psychological levels that guide buy-sell decisions and reveal the direction of the supply-demand balance. This descending trend has served as a resistance line, repeatedly tested by price, but never successfully broken. Each time the price touches this trend line, selling pressure increases, and the price is pushed back down. This indicates that sellers still dominate the short-term market. However, it's also important to note that each test weakens the trend line, increasing the probability of a breakout. A common principle in technical analysis is, the more a support or resistance is tested, the weaker it becomes. In this case, the descending trend line is weakening, and the possibility of a breakout is growing. To draw a descending trend line, at least 2 peak points are needed. But in this chart, more than 3 peaks can be observed, confirming the strength of the descending trend. However, another notable detail is that each new peak seems to be met with less aggressive selling pressure. This signals that sellers are losing strength, while buyers are pushing the price toward the trend line with increasing determination. In other words, there are signs of a potential shift in the market. These kinds of setups often precede breakouts. A breakout from a descending trend line is a significant technical development. It signals that the price may be freeing itself from downward pressure and entering a new phase. For short-term traders, such breakouts often mean a trend reversal signal. In these scenarios, traders typically look for 2 things. First, a breakout supported by strong volume, and second, a retest of the trend line post-breakout. When both occur, the trend change is considered more reliable. This short-term descending trend also reflects investor psychology. Its existence shows that investors have been viewing every price rise as a selling opportunity. But the more frequently the trend line is tested and the closer it gets to a breakout, the more investor psychology begins to shift. Sellers become more cautious, while potential buyers wait on alert. When the breakout finally happens, a majority of the market believes in the trend reversal, often triggering momentum to the upside. Once the descending trend line is broken, the first target is usually the most recent swing high. A swift move toward this level can be expected. If strong volume accompanies a breakout through this level, the price may reach new highs. However, if the price reaches this level and is rejected, investors should be cautious. In such cases, the broken trend line may be retested, and if this test is successful, the uptrend can continue. Otherwise, the move may be a fake breakout. In conclusion, the short-term descending trend line currently observed on the chart carries critical importance. Its presence indicates that the price remains under downward pressure and that investors have not yet fully committed to the buy side. However, the trend line is being tested more frequently, and the price appears to be building momentum to break through. If the price decisively breaks this trend line with volume support, it may mark the beginning of a short-term upward move. But we must look beyond just trends. Other metrics must also be considered for a complete analysis. Stay tuned. When we carefully examine the chart, it becomes clear that the price has been in a distinct downtrend for some time. This is where the concept of trend structure, frequently emphasized in technical analysis, becomes especially relevant. In the current chart setup, we observe that the price has been forming consecutively lower highs and lower lows, which fits the classic definition of a downward trend. From a technical standpoint, the presence of lower highs and lower lows indicates that sellers still hold control and remain dominant in the market. Such a structure suggests that investor sentiment about the future is generally pessimistic. Even those who wish to buy are waiting for lower levels to enter the market. As a result, each new high is lower than the previous one because investors believe the price cannot go much higher and tend to take profits early. Similarly, each new low forms lower due to panic selling, attempts to cut losses, or buyers missing the opportunity in a falling trend, all driven by psychological factors that reinforce this pattern. However, there's another key dynamic to consider. Every downtrend eventually comes to an end. One of the strongest signals that a trend is ending or about to reverse is the classic higher low higher high structure. When the price forms a low that is higher than the previous one, followed by a high that surpasses the prior peak, it suggests that investors are starting to price in a bullish outlook rather than a bearish one. This provides a strong signal that an uptrend may be beginning. First, the formation of higher lows indicates that selling pressure is weakening and buyers are willing to step in at higher levels. This is the first sign that the market may be ready to reverse direction. The subsequent higher high then confirms that the move is not just a temporary bounce, but a sign of increasing buying strength and expanding bullish potential. At this point, one of the most frequently asked questions by investors is, when can we confirm a higher low and higher high pattern? The answer is fairly simple, but requires close monitoring. First, the price must pause and begin to rise from a level above the previous low. Then, that upward move must break above the previous high. Once both of these events occur, the higher low and higher high structure is technically confirmed. At that point, we can say the trend has shifted from down to up. The higher low and higher high pattern also reflects a significant shift in investor psychology. New market participants begin to enter because they now believe prices may rise instead of fall. Existing investors, rather than cutting losses, choose to hold their positions, which increases buying pressure. As a result, supply decreases while demand rises. When these dynamics combine, the trend reversal becomes more evident, and the market transitions into a bullish phase. In summary, the current chart still reflects a downtrend. However, if the price begins to form a higher low followed by a higher high, this will signal that the market is now pricing in a bullish rather than bearish scenario. For investors, this structure is the first and most important indication of a trend reversal. Identifying and correctly interpreting this setup can provide a major advantage for those looking to position themselves early. For this reason, investors should keep a close eye on these kinds of price structures and always be prepared for potential trend changes. When we carefully analyze the current structure on the chart, it's clear that the price is currently trading at a highly critical technical level. The importance of this level stems not only from its historical behavior, but also from its relationship with one of the most fundamental tools in technical analysis, the 200-day exponential moving average, EMA. The 200 EMA is a widely followed trend-defining indicator used by many investors, not just on daily charts, but also on hourly and weekly timeframes. For this reason, the price's interaction with the 200 EMA carries significant signals for investors seeking direction in the market. Looking at the current chart, we can see that the price is positioned below the 200 EMA. While this technically presents a negative outlook in the short to medium term, it also holds major potential. The longer the price remains below this level and continues to test it, the more this level starts to act like a resistance. If the price manages to break above this important moving average, it could trigger not only a resistance breakout, but also a major shift in market sentiment. The significance of the 200 EMA in technical analysis is profound. This average represents the long-term trend of the market, and as long as the price remains below it, investors generally consider the market to be in a downtrend. Conversely, when the price breaks above the 200 EMA, the overall sentiment shifts to a more bullish perspective. Therefore, the 200 EMA is more than just a line on the chart. It also represents a psychological barrier in the market. A large portion of investors become more willing to take long positions once the price moves above this level. In this context, the current situation gains importance as the price makes an effort to break above this moving average that has long acted as resistance. If the price manages to break above the 200 EMA with strong volume, it would signal not only a technical breakout, but also a shift in control toward the buyers. In such a scenario, sellers are likely to retreat while more buyers enter the market, potentially giving the price upward momentum. We need to closely monitor the 200 EMA. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.